This conference will now be recorded.
Good morning, everybody, and welcome to this webinar on the budget update, which is going to be given by Chris Bentley, our tax director. So feel free to ask any questions, as we always like these to be as interactive as possible. And feel free to unmute yourself or switch your camera on and shout out, or use the chat box facility. You'll see a chat box in the top right hand corner of your screen. You can post any questions in there if you like, or if you want to post any of your details in there, ask for a call back, please feel free to do so. If you've missed anything on the call, then you can actually catch up on our YouTube channel later on, where this video will be posted. So this session is being recorded. You can also follow us on Spotify, on LinkedIn, on Twitter as well. So there's plenty of free information out there, which we intend to continue to make freely available to all. We have various webinars coming up, and Chris will no doubt cover that. So I just want to introduce you to Chris Bentley, our tax director, who's going to take over from me now and present this webinar. So over to you, Chris.
So thank you very much, Stephen. Yes, it's Chris Bentley here, Tax Director here at Harts. If you're expecting me to talk completely on the budget, I'm going to go a bit wider than that because, as you probably know, there wasn't a huge amount in the budget in terms of tax changes. So we're going to go a bit wider and consider some tax planning for business owners as well today. But before I go into the presentation, I do need to put up the usual disclaimer that this presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. So as I've said, this webinar is covering tax planning for business owners as well as the budget last week. The starting point for the budget and what went on is it was actually much quieter than those we've seen over the past 12 months. If you cast your mind back to last autumn, and we had, I think, we had a mini budget, we had a reversal, we had another reversal, we had then a change of governments, and finally pretty much everything that was in the original mini budget was put in the bin. Thankfully, we've not had any kind of change on that level. It's all a lot more stable. We know what's going on. Agree or disagree with it, we know what's happening, and that makes planning and our lives as accountants and your lives as business owners much easier because we know what the landscape we're dealing with. We're not waiting for massive rabbits out of headlights at 2 minutes notice. So what have we seen in the budget? No significant changes to the previously announced policies. The main policies there being the freezing of allowances, the corporation tax rate increase, and the like. However, there were two big changes that I think caught the eye. One was in relation to pensions, and I'll cover that in a bit more detail during the course of this presentation. There was a significant expansion of government-funded childcare. That's not the subject of this presentation in the same way that home fuel bills are. I need to put it on there because it was a major part of the budget, but it's not something I'm going to be talking about. So we'll start with where things are from an income tax, national insurance, capital gains tax, corporation tax perspective, including the few changes that were made in the budget. So the starting point is that most income tax rates and allowances are unchanged, and that's planned to be the case until 2028. The personal allowance is currently 12,570. And then on top of that, your basic rate band is 37,700, making the higher rate threshold £50,270. Different rates apply and different allowances if you're in Scotland. This is all for those who are in England, Wales or Northern Ireland, who I'm assuming is everyone online today. Once your income has gone over 50,000, then if you or your other half is claiming child benefit, then there was withdrawal of child benefit between 50,000 and 60,000. And then you're back at 40% tax up to £100,000, where the personal allowance is withdrawn. That has been the case for a number of years, and the personal allowance is fully withdrawn at once your income reaches £125,140. Now, the change that comes in from April 2023 is that top rate tax, so that's 45% on most sources of income or 39.35% on dividends, that top rate of tax will apply for the 23-24 tax year and thereafter once your income reaches £125,140. That's a significant reduction on the 150,000 threshold that we've had previously and for a number of years. It would also be wrong of me not to mention the dividend allowance, which currently allows you to receive up to £2,000 worth of dividends without paying any tax. That will be cut to £1,000 from 6th of April this year and then £500 next year. For most business owners who take the majority of their income in the form of dividends, it won't make an enormous amount of difference to their tax liabilities because that £1,500 from £2,000 down to £500 is taxed at 8.75%. So you're talking maybe £120 additional tax in 2 years' time. National insurance rates are frozen until 2028, which means that employers' NIC contributions will kick in once an individual's salary reaches £9,100. That's at 13.8%. And employee national insurance contributions will kick in once an individual's salary reaches £12,570. That's the annual amount. If you're running your payrolls weekly or monthly, that amount is divided by 52 or 12. Capital gains tax. There has been a lot of talk in recent years about increases to capital gains tax rates, a potential alignment with income tax. It's not happened. The top rates remain 20% for most assets and 28% for residential property disposals. However, the annual exemption, currently £12,300, is being reduced to £6,000 from April this year and to £3,000 from April next year. I think they're targeting mainly people who have investment portfolios and who will deliberately sell and rebuy shares each year to make full use of their annual exemption and so increase the base cost of those shares. For those who are making a disposal 1 year in 10, for example, a property or a business, I don't think that's going to make a huge amount of difference to behaviour. Yes, having another £9,000 taxable at 20% is going to increase tax bills by £1,800, £2,000, a bit more for residential property. But I don't think it'll change the economics of when people dispose or whether they choose to. It will be those with investment portfolios that ultimately get sold, and there's a lot more tax involved in there. That's where the government will be looking to make their money from that. And piece of good news, business asset disposal relief, sometimes still called by its old name of entrepreneurs relief, that remains available and gives you a 10% tax rate on the first £1 million of qualifying gains. That's a lifetime allowance for £1 million. Corporation tax, been trailed in the media, less good news here. The rate increase to 25%, which was announced some time ago, that is going ahead on the 1st of April. The 19% rate does still apply to trading companies with profits of less than £50,000, but there are anti-fragmentation rules, which basically mean it's not possible to have 2, 3, 4 6, 10 different companies, each making £50,000, and get around it that way. In practice, we expect most companies will be paying tax at more than 19% going forward. The super deduction, which has enabled companies to claim a deduction worth 130% of qualifying expenditure on new plant and equipment, that finishes on the 31st of March. So if you are buying something and you want to make use of it, you've got until a week on Friday to incur the expenditure. Going after that, however, there is a small change in that the annual investment allowance, which enables you to write off 100% of the cost of plant and machinery, computers, office equipment, vans that you've bought in your business, that will remain at £1 million a year. It had been expected to be reduced significantly. The government's big announcement of full expensing is unlikely to impact many SMEs. That's not because it's a relief for big companies, it's because SMEs are unlikely to exceed their annual investment allowance for £1 million anyway. You're only interested in full expensing if you can't cover all of your expenditure with the AIA, the annual investment allowance. So the takeaway is, as has been the case for a number of years, if you're investing in the business, buying assets, whether that's plant and machinery, computers, office equipment, vans, then you get a full write-off for those against your taxable profits in the year of purchase. There are also some changes to research and development tax relief, which I will mention later in this webinar. So in terms of a bit of tax planning and thinking through what all of those changes might mean to you as a business owner, I'm going to look at a few areas, profit extraction being the first one, but I'm also going to be looking at research and development. I'm going to be looking at pensions, and I'm also going to look at some changes to income tax and how sole traders and partners will need to calculate their profits going forward. But starting off, we'll look at profit extraction. For years, the received wisdom has been that business owners should should operate through a limited company. They should take a small salary to use their personal allowance and then take the remainder of their income in the form of dividends. And if you look at this table, which shows the effective tax rates on various income sources, types of income for the current tax year, you'll see why that's the case. If you're a sole trader paying tax at basic rate, your effective tax rate, this is income tax and national insurance combined, is 29, nearly 30%, rising to 42, nearly 43 at higher rate. But someone who takes their money out, operates through a limited company and takes a small salary covered by the personal allowance, and then the remainder as dividends, pays tax at 26 and then 46. The dividend tax rates have been increasing over the past few years, but we'll really see a change next year. I've also included on there for comparison the effective tax rate on those taking money out of their company by way of rent. For example, if they own a property personally and are able to charge the company rent, or if the company owes them a significant sum on their director's loan account. The tax rate on extracting money that way is actually the cheapest, 20% at basic rate, higher rate tax at 40%. Pay as you earn is the most expensive. By the time you've taken into account employee and employer national insurance rates, contributions, and the income tax on that salary, these figures are for someone who's of working age, then the effective tax rate is 40% for a basic rate taxpayer, or 49 for a higher rate taxpayer. As you can see, it's the most expensive way of doing it. If we move forward to the position that will apply from next April, when I say next April, about 3 weeks' time, corporation tax rate has gone up to 25%, and that's the assumption we're making in this table. You'll see that the effective tax rate on taking money out by way of rent or interest is unchanged. You get a corporation tax deduction for that, but you're still paying 20% tax or 40% income tax. If you take the money out by way of pay as you earn, you get a corporation tax deduction for the salary. So you're not paying any corporation tax, but the income tax and pay as you earn, national insurance is again unchanged. So those rates, there's no increase. However, for those who take the money out as dividends, we're now paying 25% corporation tax on the profits, and then you're paying 8.75% income tax on what's left at basic rate, or 33.75% at higher rate. And that's how we come to those total effective tax rates of 31.5 roughly for basic rate taxpayers on dividends, and little over 50 for higher rate taxpayers on dividends. Both of those, you'll notice, are slightly higher than taking your money out via PAYE. That I will return to in terms of how you might want to structure things going forward, but it's worth noting that the sole trader, and that would also apply to a partner in a partnership, their tax rates at basic rate are now slightly lower, 29% for the profits arising within basic rate. That's 20% income tax and 9% national insurance, 42% at higher rate and 47% at top rate. They're lower than operating through a company. So I think anyone who's setting up, it's definitely worth thinking long and hard about whether you actually want to have a limited company. You might be better being a sole trader, a partnership, or an LLP instead. And there are some disadvantages, but it's definitely worth considering. I think it's also worth noting the increase on today. The sole traders, partners in a partnership, they're all saying a small tax cut next year, that 0.73%, whereas those operating through a company are seeing big tax rises. The reason the sole traders and partners are getting a tax cut, it's part of the fallout from last autumn's mini budget. National insurance went up, it came back down again. But there was a hybrid rate left in place for 22-23. However, although the tax rate on dividends went up alongside national insurance, the tax on dividends didn't come back down again. I'll let you read into that what you will. So, what does all of that mean? It does mean that the received wisdom of taking a small salary and the rest as dividends isn't always the best course of action going forward. There's a massive reduction in the difference between taking dividends and business owners being on payroll. So you may still want to take dividends, though. It may still be much more tax efficient for you. For example, it opens up opportunities for income splitting with a lower earning spouse. Are you actually drawing all of the profits that the company makes? If your company's making £300,000 a year and you only want to draw out £100,000 a year, you'll pay a lot more tax operating as a sole trader or a partner in a partnership or an LLP as you will as a company, because you can leave the undrawn profits in the company. But for some people, and I think particularly those over state pension age, there may well be a benefit in switching from dividends to pay as you earn. There will still be downsides. It brings forward the tax point, so you're paying the tax in real time rather than in arrears as dividends. There's also, for technical reasons I won't go into, it will actually bring more of your tax into higher rate bands. So it's not an easy equation that the figures here suggest. It's not automatically better to go pay as you earn over dividends for that 1% saving. I think most people will probably, who've got a limited company, will probably want to stay on dividends. But it is definitely worth considering. And for a new business, whether a sole trader or partnership or LLP is preferable. So what else could we do in terms of swerving the corporation tax rise? I think there's a lot to be said around bringing forward profits. If there's things that you're maybe holding off billing because you think, oh, well, I want to do it in next year because I can put the tax back a year. Well, actually, strangely, this year you want your profits to be taxed earlier. There are things that can be looked at around changing year ends, but they would need to be individual conversations. Pension contributions, which I'll come on to later, are increasingly valuable. They're tax deductible for corporation tax purposes. You'll save 25% corporation tax on the amount that goes into your pension. That's up from 19%. Rent and interest are still tax advantaged, I mentioned earlier. So if your business owes you a lot of money on the loan account, if your business operates from a property that you own personally, it may be an opportunity to look again at whether you should be charging interest on your loan account, whether you should be charging rent on that property. And the final point, and it's not something I'm going to labour here, is that the increase in corporation tax rate shifts the equation for buy-to-let holding perhaps back towards personal ownership slightly. That's a whole different strategy. It's a whole different consideration there, and not something I'm going to go on further at this point. So the big change in this year's budget, pensions. The headlines were all around the annual allowance being increased to 60,000, the lifetime allowance being abolished, and how that is going to free up pensions and stop doctors from retiring. Of course, the opposition came out the same day or the day later and said that they would put the lifetime allowance back in. Whether they will or not, I don't know, but it's why I've said, at least for the time being, I wouldn't like to be a financial advisor advising a doctor at the moment, due to the considerations around the lifetime allowance. But let's work for the moment on the basis that we have no lifetime allowance and you can put in £60,000 a year. This is a really, really valuable way of extracting money from the limited company. If your salary, your total income plus your employer pension contributions is less than 260,000, then that full 60,000 is there from next year. For the last few years, it's been 40,000. But what this means is someone who had a pension some years ago, and so there's an open pension pot, but hasn't put anything in for a number of years, come the 6th of April, they'll be able to put in £180,000 into their pension. That's 60,000 for the 23-24 tax year, plus 3 lots of 40,000 for the previous 3 tax years. That achieves a tax saving at 25% on 180,000 of £45,000. The money in the pension is it grows tax-free. When you come to take the money out of the pension, then the first quarter of it is usually going to be tax-free, and the rest of it will be taxed as your income at that point. But it's taxed at 20 or 40% with no national insurance on it. And that applies whether you're above or below state pension age. So actually, it can be an incredibly tax efficient way of getting money out of a limited company over the long term, and should definitely be seen as part of a business owner's long-term profit extraction strategy. It can also be a very valuable part of a business owner's inheritance tax planning strategy, because in almost all cases, a pension will be outside your estate for inheritance tax. That assumes, of course, that you've not bought an annuity and that there's a lump of money that you are able to draw down on. So as you can see, there's some huge tax benefits from using pensions as a tax planning vehicle as well as an investment vehicle. And with a lifetime allowance, we don't need to worry about hitting the 1.07 million, the current lifetime allowance, and then suddenly anything after that being taxable at 55%. So it's a massive relaxation and definitely worth looking at. We've got it for next year. The government said that. I think it's unlikely we'll see an election before April 24, so you've probably got it for at least 2 years, whatever the next government chooses to do. However, what I will note is that when the lifetime allowance has been reduced in the past, there's always been transitional protection for those whose pension pots have exceeded that amount. Couple of potential things to note as well on the tax side is that the tax-free lump sum has been capped at 268,275 for those who've not already got protections in place. If you're thinking that is a very strange number, where on earth did the government get that one from? It's a quarter of the current lifetime allowance. So what's happening is the lifetime allowance is being abolished, but the tax-free lump sum is being capped at that amount. So the summary on pensions, as I say, is they're a very valuable tax planning vehicle. However, massive caveat, you can't draw from a pension until you're 55, or that will rise to 57 from April 2028. So I can talk to you about the tax side of these things and the valuable tax reliefs around them, but you need to take financial advice as to whether putting money in a pension is right for you in terms of locking it up until that minimum age. And indeed, you will also want to take financial advice in terms of how you invest that money once it's in the pension pot. Our comments today are limited wholly to the tax benefits of pensions. So the next area I'd like to touch on more briefly in this case is research and development. For years, research and development has been the tax relief that the government, that the revenue wants you to claim. There's been a lot of effort put into encouraging businesses to claim, a concern that claims might be being missed. However, that position has shifted significantly in the last year or two. Unfortunately, the less reputable parts of the tax profession, what I'll call the tax avoidance industry, has turned up on research and development tax relief, and the government is aware that a number of more spurious claims have been made. There's also concern in government that the tax relief is perhaps not encouraging development in the way that they would hope it might do. It's very valuable, but they're not convinced that they're seeing the benefits in terms of development. Whether or not that second bit is true or not, I don't know, but we are in a position where the goalposts have shifted significantly, and I think it would be fair to say it is no longer the relief that the government wants you to claim. The additional tax deduction that you currently get for qualifying expenditure is 130%. From the 1st of April, that drops to 86%. So the relief becomes significantly less valuable. £100 of expenditure currently gets you a tax deduction for £230. Going forward, it's only 186. There are also going to be some changes to the scope of what can be claimed. Some of those are small extensions to reflect costs that businesses might incur now on cloud computing, for example, that simply didn't exist when the R&D regime was originally constructed in the early 2000s. Other changes actually narrow the scope of what can be claimed, and one of those that's worth noting, although its introduction is now next year, is that there'll be a restriction that costs have to be incurred in the UK. So your employees would need to be on a UK payroll. If you've got subcontractors, in almost all cases, they will need to be based in the UK. However, the real change, I think, is going to be around the claims procedure. Best practice has been for years to submit a report which sets out what's done and why the project is R&D for tax purposes, and then to include a summary of the qualifying costs within that report. That's the approach we've always taken for R&D claims that we have taken. Effectively, that's going to become mandatory for claims undertaken after the 1st of August, or so to say, submitted after the 1st of August. But the form will be much more regimented, and you can guarantee that it will become a lot more difficult to claim R&D, because there'll be a form filling requirement as well as setting out what's been done and why it's R&D. Those making R&D claims will have to personally approve them as well, and agents involved will put their names to it. We do that anyway where we're doing the claim. So it's best practice with a personal affirmation, shall we say, from one of the directors for the company. But because of the extra admin around it, it is going to become more difficult, more complex, and more burdensome. There will also, and this is definitely worth noting, they're planning on introducing a pre-notification requirement. So at the moment, you have 2 years from the end of a tax year to make an R&D claim through the tax return. Going forward, you'll get 6 months to notify the revenue, and then your 2 years to make the claim. And if you haven't pre-notified the revenue that you plan to make a claim, that's it. You can't claim for the R&D. Doesn't matter whether it's genuine or not, you have to have pre-notified. There's a lot of pushback from the professional bodies on this one, because they don't think it will actually deter any tax avoidance or inappropriate claims, but what it will do is will push out genuine claims that are then no longer going to be possible to be made. If you're thinking of doing R&D, if you are undertaking some R&D, we need to know far sooner than we would have done historically, so that pre-notification can be made. And finally, I will also note that if you have done an R&D claim, HMRC are looking at the claims much more closely. Even if you put in a report with full calculations, we've seen various instances of the revenue just send out a letter that says, explain it all in lots and lots of detail. And you're thinking, well, I've sent in a report. They're sending a template letter that is basically looking at it from scratch. Whether that's a good claim, less good claim, we've got contacts within the R&D who are R&D specialists as well. They're seeing exactly the same. Good claims, bad claims, they're all being hit in the same way. The revenue attacking all of them. So move on from that. Basis period reform and making tax digital. We have done webinars on these, full webinars in the past, but I think it's worth a couple of minutes just to recap as part of the tax planning side of this webinar in terms of what's changing and what those who are currently sole traders, partners in a partnership, partners in an LLP, or renting out properties, buy-to-let commercial properties, need to be aware of. First one is basis period reform, and this affects trading income. So sole traders, partners, LLP members. So the income tax basis period reform means that all businesses will be taxed on the profits arising in the tax year from the 2024 to 25 tax year. That's next year. So the tax year we're just moving into is the transitional year. For those who've currently got a year end other than the 31st of March or 5th of April, this means that in 23-24, so the tax year you're moving into, you'll be taxed on more than 12 months of profits. So let's say you're currently a June year end, you pull your accounts up to the 30th of June each year. The accounts for the 30th of June 22 will be taxed in the 22-23 year. The accounts for the 30th of June 23, so that's 1st of June 22 through to the 30th of June, sorry, 1st of July 22 to the 30th of June 23 are taxed in 23-24, and the profits from the 1st of July 23 to the 5th of April 24 will also be taxed in the 23-24 tax year. When you start a business, you would have something called overlap profits, and relief is given for those as well. But in most cases, we would expect that those who've got a year end other than the 31st of March or 5th of April will have higher taxable profits in the 23-24 tax year. And therefore, there is some planning can be considered in terms of how we deal with those profits. There are easements within the transitional rules to avoid that being any more painful than it needs to be. But if you are in that position, we will be getting in touch with you shortly to invite you to discuss it further. So the other change that's coming up on the income tax side is making tax digital. That was originally scheduled to come in from April 2024 and to require all trading and rental businesses with gross income of more than £10,000 to submit quarterly updates of pretty much all of their transactions to the revenue through appropriate software. The revenue weren't ready, taxpayers weren't ready. The threshold of £10,000 gross income would include lots of businesses or operations where there was never going to be any tax due. It was a lot of work for, in many cases, probably little gain, which meant that it was increasingly be seen as making tax digital, perhaps standing for something else, making being the first word, things being the second word. Anyway, there was an announcement before Christmas that there would be a postponement for that. Nothing is now coming until April 2026, and the threshold will now be £50,000 of gross income from April 2026, and that's planned to reduce to £30,000 from April 2027. I think it's much more likely something will come in around that time and around those thresholds. You're not a million miles away from the VAT threshold at £50,000, and those businesses will already have software in place, some kind of analysis going on. So that's planning, it's on the horizon, but it's now much further into the distance. And then the final part of this webinar is, I think it would be incorrect not to remind those who employ people that there is a significant increase coming in both the minimum and the living wage as of the 1st of April. And the reason we really need to put that out is you don't want to inadvertently fall foul of that. The minimum wage is going up by around 9.5%. So even those who gave a pay rise of 6 or 7% across the board last year may well find that they have individuals who suddenly hit minimum wage from April and need to look at what they're paying. So I'm putting up the rates at the moment that will apply from the 1st of April. So, and then that brings to an end the tax content of today's webinar. I put up the slides in front of me, which sets out the next 3 webinars that we're planning. I don't know, Stephen, if you want to say anything more about those. I'll hand over to you.
Yeah, thank you very much indeed. Yes, the next one's on the 20th of April, where we're going to have Steve Gomez from Amiga Finance, and he is a commercial finance broker, and he will be looking at what you need to do these days to raise finance, what are the sorts of rates you can expect, what your records, the state of your records needs to be, and so on, to be able to get some finance, and what you shouldn't be doing, which could actually influence against actually raising finance for your business. So that should be a very interesting webinar from Steve Gomez. And then on the 16th of May, we have a presentation by the Cyber Resilience Centre, and I believe we have a DCI who's actually going to be giving the presentation. It's all about what they've seen and how people are being scammed, what scams are out there, what you can do to protect yourself against all these scams and so on. So that should be a very interesting webinar given on the 16th of May. We're also looking at putting one on in June. We've not got a date fixed yet for you on exporting and free ports. So there's some information there available if you are wanting to do exporting or importing or so on. So there's also a load of information there. That will be in June. We will then be breaking for the summer. And we're starting again in September. Now, if there's any webinar you'd like us to cover, any information you want us to do, then just drop me a line at Harts, and we'll pull something together. We'll be sending out our new schedule later in the year. Has anybody got any questions that they want to ask about anything that has been raised today? Please feel free to unmute yourself or put a question in the chat box. There was more information on basis period reform on our YouTube channel. There's a short video on there as well, just a few minutes long, to explain what it's all about. But as Chris has said, basically, if you're a sole trader or a partnership, then you are affected by this. There is no escaping it. You might not be too affected if you've got a 5th of April year end, but if you haven't, then you are. So it's well worth having a watch of that. Or if you know of anybody who is in this situation and hasn't yet been advised of the changes, then please feel free to ask them to get in touch. We'll happily have a chat to them. So has anybody got any questions that they want to raise or anything they want to put in the chat box? Feel free to unmute yourself. No? Okay, great. Well, no questions this morning. Thank you very much indeed, Chris, for presenting that very informative webinar on the budget and other matters as well. And I look forward to seeing you all on the next webinar. If you've enjoyed this webinar, please feel free to ask others to join. It's open to clients and non-clients alike. We'll happily give this information out for free. And we look forward to seeing you on the next webinar. Have a great day.